Hello friends, we'll be discussing another illustration which will be related to the ratio analysis itself. We'll have to go through the 4 categories of ratio that we'll be defining in this specific illustration. So when we speak about ratio analysis, we basically want to understand the kind of different standards that we have, or rather the parameters that we have for ratio analysis. Under those parameters, we have different ratios which are supposed to be defined. Now, this specific illustration will give you the details of such ratios. So we'll have a balance sheet with us, we'll have a profit and loss statement with us, and accordingly we have to go ahead and prepare the further ratios like the leverage, the liquidity, the actions, or rather we can talk about the turnover and profitability, and the activity ratios is what we have to figure out. So these are the 4 main headings that we have. Under that, whatever ratios can be defined out of those balance sheet and profit and loss statement has to be prepared. So let's start with the balance sheet first. So we have divided the whole page into 2 parts. One phase will be giving you the balance sheet details for 2007 and 2008. The next phase will be given the details of profit and loss statement for the year 2008, that is for the current year itself. So let's start with it. So we have mentioned the question here. We have the items of balance sheet and the profit and loss statement as well. Let's read it out. We have cash and debtor balance for 2007-2008. These are the items related to the balance sheet. We have temporary investment and stock items along with the preliminary expenses. Or rather we can talk about prepaid expenses here. We have the total of all current assets and total assets as well. We have current liabilities, loans and capital balance mentioned for the year 2007 and 2008, and we have retained earning balance as well. So this comprises of the balance sheet items. Now on the profit and loss statement, we have certain items as well like sales, from which cost of goods sold has been subtracted and interest amounting to rupees 1,60,000 has been subtracted. The balance value, that is 10,40,000, has been mentioned here as net profit, out of which 50% has been deducted, compromising as or constituting as tax rate. That means 50% tax has been deducted, which leaves us with 5,20,000. That is known as profit after tax, and out of that 2,20,000 has been distributed profit. Now the net profit which has been defined here is EBT, that can be earning before taxation. And the profit after tax is EAT, earning after taxation. Now we have to calculate the liquidity ratio. We have to calculate the leverage ratio. The profitability and activity ratio is also a part of our calculation. So we'll start with the calculations now. That means we'll first go with the liquidity ratio here. So under liquidity ratio, we'll be finding out current ratio, and the next one is liquid ratio. So the first one will be current ratio here. Now all this calculation will be related only to the year 2008 because the profit and loss statement has been given for the current year, that is 2008 itself. So let's take that parameter into your mind and then try solving all these items. So current assets and current liabilities are to be taken only for the year 2008 here. So the first ratio, that is current ratio, that we have figured out is 3.81. 30,52,000 is the current liability, or rather we can talk about the current asset. Current liability amounts to rupees 8 lakhs here. So 30,52,000 divided by 8 lakh will give you a value of 3.81, which is the current ratio. Now the next ratio that we'll be figuring out is the liquid ratio here. So the next ratio, that is liquid ratio, also known as acid test ratio, can be figured out with the formula that is liquid assets upon liquid or rather current liabilities. So liquid asset will have only cash or near to cash items. So current assets, the total, that is 30,52,000, out of that will subtract out or will take out the stock amount and the prepaid expense amount as mentioned in the balance sheet here. So 30,52,000 minus the amount that is 21,60,000, which refers to the stock, and 12,000 as prepaid expenses will be subtracted out from it. Whatever answer we have will be the ratio as liquid test ratio or rather acid test ratio. So the value that we get here is 8,80,000 divided by 8 lakh. That will give you somewhere around 1.1. So we have figured out the liquidity ratio, that is current ratio 3.81, and the liquid ratio, that is 1.1. So let's go on to the leverage ratio now. So under leverage ratio, we'll be covering debt equity ratio and interest coverage ratio. These are the two ratios that we'll be covering under debt equity ratio or rather leverage ratio. So let's start with the first one, that is debt equity ratio. The formula for debt equity ratio is long-term debt upon equity fund. That is the formula that we have mentioned here. Now, under the balance sheet that we have been provided with, let's figure out what do we have for long-term debt and what do we have for equity funds. So the items that we have here in a balance sheet is, for long-term debt we have loans, and the other items for equity fund we have capital amount plus retained earning. That will give us the proprietors fund or rather the equity fund as mentioned. So for loans we have a total amount of 16 lakh, for capital we have a total amount of 20 lakh, and for retained earning we have a total amount of 8 lakh 12,000. Now 16 lakh divided by the total of 20 lakh plus 8 lakh 12,000 will give you 28 lakh 12,000. So the debt equity ratio that we have figured out is 0.57. That is the ratio of debt is to equity. Now the next ratio that we'll be covering is interest coverage ratio. So the formula for interest coverage ratio is EBIT, that is earnings before interest and tax upon the interest charge. That means how much interest has been charged here. Definitely we can look at the debentures or any other interest that is getting deducted or that is getting paid off. For the earning before interest and tax, if you see the sales item or if you see the profit and loss statement, we have sales amounting to rupees 40 lakhs, and out of that we have certain item getting deducted, that is amounting to 28 lakh, and after that we have interest being minus or subtracted from that. So sales minus cost of goods sold will give you the earnings before interest and tax, because only after that 1,60,000 of interest has been subtracted. So you just have to do 40 lakhs minus 28 lakhs, that is sales minus cost of goods sold, will give you an amount of 12 lakhs there. And the next item that we have, that is interest charge. So basically the denominator is interest charge, which has been already mentioned in the profit and loss statement, that is 1,60,000. So the interest coverage ratio that has been figured out is 7.5 times. That means that is the interest coverage ratio, and here with this we conclude the liquidity, or rather we can talk about the leverage ratio that we have covered out here. So debt equity ratio of 0.57 has been covered under leverage, and the interest coverage ratio of 7.5 times has been also covered under leverage ratio. Now after this we'll start off with the profitability ratio. Now the next phase that we'll be starting off with is the profitability ratio. The first thing that we'll be doing is the gross profit ratio. Now the formula for gross profit ratio is gross profit upon sales into 100. So to figure out the gross profit, that means sales minus cost of goods sold, that will give you the gross profit exactly, because this is a part of trading account. After which if you subtract the interest, that will give you the net profit there. So the gross profit here, as we have figured out in the earlier scenario, is 12 lakhs. The sales item has been already mentioned, which is 40 lakh rupees. So that gives you 30% as the answer. Therefore, the gross profit to sales is 30%. Similarly, the next ratio that we can figure out is the net profit here. The formula remains the same. Instead of gross profit, you will put down net profit there. Now, the net profit has been already given to us in the statement, that is profit and loss statement, which is 5,20,000. Sales amount we already know. So let's figure out how much is net profit percentage. So the answer that we get here is 13% basically. So until now we have calculated gross profit and net profit ratio. Let's check what other ratios do we have under profitability sector. So the next ratio that we'll be covering is return on total assets. The formula for that being profit after tax upon total assets into 100. We have both of these values with us. Let's replace them and figure out how much is the percentage here. So the return on total assets, the answer is 8.12%. 5,20,000 being the profit after tax and total assets being 64 lakh for the year 2008 has been taken into consideration, and that gives you a value of 8.12%. So the next ratio that we'll be covering here is return on total capital employed. Now the formula has been mentioned down here. The formula states as PAT, profit after tax, plus current year's interest divided by 2, and the whole is divided by the total capital employed, and that is multiplied by 100, which will give us the format into percentage thing. So let us put the values there. So we have figured out the total numerator, that means 5,20,000, that is profit after tax, plus interest, that is 1,60,000 divided by 2. Now the total capital employed will be loans plus capitals plus retained earning. So that gives us a value of 13.6%, that is return on capital employed. So in this sheet we have calculated return on total assets, which is amounted to 8.12%, and return on total capital employed, which came about to be 13.6%. Now let's figure out the last ratio of profitability sector. Now the next ratio that we'll be calculating is return on equity fund. The formula has been mentioned down here. That is profit after tax, that is 5,20,000 upon equity fund or the proprietor fund, which has been already calculated as 28,12,000 multiplied by 100. So that gives you a value of 18.5%. That is the return. So the last ratio of profitability has been figured out, that is 18.5%, that is return on equity fund. Now the next part that we have to figure out is the activity ratio. Now the next part refers to the value that we'll be considering for 2007 and 2008 itself, because activity ratio will give you average concept, or the concept of average will be utilized here. So the first ratio that we're figuring out is debtors ratio, or you can call it as debtors turnover ratio. The formula is sales upon average debtor. Hence the balance sheet will have 2007 2008 value to be clubbed together and divided by 2. So the sales value is 40 lakh, which has been already mentioned. The debtor value, that is 3,20,000 for 2007 and 4 lakh for 2008, will be clubbed together and divided by 2, and whatever answer we get is your average debtor. So that is 7,20,000 divided by 2 will give you 3,60,000 as average debtor. So the value that we have got here is 11.11. So the debtor turnover ratio is 11.11 times. Now the next ratio that we'll be figuring out under activity is the stock turnover ratio. So the formula is cost of goods sold upon average stock. We already have the value of cost of goods sold, we just have to take the average of stock here. So for the average of stock, we have 2007 mentioning as 18,40,000, and for 2008 we have the balance of 21 lakh. Club them and divided by 2. You get a value of 20 lakhs here. Now that is the value that we are looking out for as average stock. Now 28 lakh divided by 20 lakhs will give you the average stock turnover ratio. So the value that we have figured out for stock turnover ratio is 1.4 times. Now the last ratio that we'll be dealing with is the total asset turnover ratio. The value being sales upon average asset is the formula. Let's utilize that. So the value that we get here is for the average asset as 54 lakhs for 2007, 64 lakhs for 2008. So that will give you a value of 1 crore 20 lakh, that is 56 lakh and 64 lakh divided together, 1 crore 20 lakh then divided by 2, you'll get a value of 60 lakhs here. Now that is the last thing that we're supposed to do, 40 lakhs divided by 60 lakhs. That gives us a value of 0.666. You can round it off to 0.67. The total asset turnover comes to 0.67 times. and the stock turnover, as we calculated earlier, came to 1.4 times. So this marks the closure of this illustration. I hope we understood how we are able to solve, or how are we supposed to solve the four kind of categories that we have in question, that is liquidity, profitability, the next one being the activity ratio, and the earlier being the stock turnover, or rather the profitability ratio here. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.